So good to see everyone. Hope you're well. This session's slightly different than what you've heard thus far this morning. This discussion is going to be focused on understanding and mitigating systemic risk in global finance. We have a great panel today, so let me make some quick introductions. Immediately to my left is Taylor Burnett. He's the research lead for the Americas at the World Gold Council, and he has extensive expertise in the areas of global capital markets and asset management. Taylor has also held leadership positions in risk management and as an investment analyst working in both public equity and private equity portfolios. On the far side is JANIE VEGA Fernandez, and she's the head of investment P&C at Zurich Global Investment Management and is responsible for the implementation of the investment strategy for the US and Canada. Prior to her current role, JANIE was a portfolio manager in Europe and drove Zurich's implementation of responsible investment strategy in Spain. And finally, here in the middle is KRISTEN Walters. She's a recognized chief risk officer, chief operating officer, and risk leader in financial services sector. She's held leadership positions at BlackRock, at Goldman. She also worked at the New York Fed and has spent 6 years as a member of the Commodities Futures Trading Commission's Market Risk Advisory Committee, where she helped oversee systemic risk in security markets and exchanges. So that's the perfect fit for today's conversation. So again, thanks so much for everyone for being here. Let's just jump right in, and we're going to focus on the topic at hand. The global financial system is more interconnected than ever. You all know that. A disruption in one institution or one region can cascade across borders and markets in seconds. We all saw this in the 2008 financial crisis, which really illustrated how rapidly systemic risk can spiral into a global economic shock. Now, nearly 2 decades later, the architecture of global finance has changed, but there are new vulnerabilities that have really emerged. So we're just going to jump right in, and we're going to start with KRISTEN, if that's okay. So KRISTEN, looking at today's landscape, what do you consider the most significant systemic risk in global finance? And where are the pressure points in the current system that could really trigger broader instability?
So I guess I'm going to say something that would have surprised me if you'd asked me this question when I started my career at the Federal Reserve Bank of Boston in the early 90s. I mean, I really think the disruption from U.S. policy, bond, currency, equity markets, and the shift away from more of a benign geopolitical environment with globalization, interconnected risk, and yes, there were certainly hotspots and things simmering across the globe, but for the most part, developed markets, nations and financial markets for the better part of the last 40 years have operated somewhat in unison. Conditions have been overall benign, and both the great moderation and the zero interest rate policy that emerged as part of the financial crisis, those were combined with fiscal policy, those were very good for financial markets. And as a risk manager, what I saw until maybe 2022 was mostly, I mean, obviously the financial crisis was an outlier, but mostly benign market environments with episodic tail shocks. So stresses from things like Brexit, Russia invading Ukraine, concerns about China potentially invading Taiwan. What I think we've seen, and it's not just in the US, it's manifesting in other countries around the world, is, and I'm not sure if COVID itself and the supply shock that that occurred at that time that disrupted markets was part of it, or it was orthogonal, but certainly we are in a time where markets have changed structurally quite significantly. We are now in an inflationary, higher rate volatility environment that to me looks like it's here to stay. I think from my perspective, yes, it was started by COVID and supply demand imbalances, but I think with the climate transition, physical climate risk, and overall commodity scarcity, which we see in the mineral space and rare earth, that I think that the issue around commodities and inflationary effects around supply and demand for economies is going to keep us in an inflationary and higher rate environment for some time. And that's happening at a backdrop of economic fragmentation where you see more nationalistic behavior, protectionist behavior, tariffs, and these are all, being initiated to a large extent by the United States, the largest financial market in the world. And I think that, most immediately, my concern is currency and bond market disruptions, the size of debt in the US, the ability for repo markets and the US, the Treasury auction process itself to be disrupted quite significantly, combined with, mass, debt that's 120% of GDP. There's just a lot of triggers that to me are emanating from the US that make me very concerned. The other thing that I would just mention is when I started my financial career again in the early 90s, yes, there were behavioral dynamics in markets and animal spirits, but to me, and maybe I was just, young and naive, for the most part, markets did move based on fundamentals and technicals, and you could apply quantitative analysis to the macro environment, micro environment, and have some sense of where and how to invest. In today's market, information is transmitting like in nanoseconds, and there's some very large players in the market who are able to analyze like systematically what's happening globally and assimilate it and act on it from a trading and investment perspective, but most people cannot. And so what I've seen is just a lot more, behavioral biases and people reacting emotionally to events and markets in ways that don't make sense given the structure of the market underneath. So, I worry about all of it, and in particular, the fact that the US is the problem, not the solution, which I'm used to having been the case for my entire professional career.
So we certainly are in uncertain times. Taylor, gold prices are at record highs as anxious investors really seek safe havens for parking their money. What are you talking to your industry leaders about when it comes to continued economic uncertainty?
Yeah, thanks, Sean. So I was recently just for instance, in Montreal and Toronto, meeting with institutional investors, and really we kind of got two main questions that were overly, continuously repeated. The first was around economic uncertainty and geopolitical risk. A lot of what KRISTEN just touched on, I would reiterate all of the same. The other part was how much higher can gold prices go? And so I think we should just break this in kind of two parts. From the geopolitical risk side of things and economic uncertainty, gold is known to be a quality safe haven asset. And that's why you're starting to see flows over in that way. But as KRISTEN actually was just saying earlier about US being a problem, some of that is also evident in when you look at equity flows. Right now, year to date, where about 50% of equity inflow is coming into the US versus 72% last year. So gold is likely been a beneficiary of that, along with more diversification into other assets and regions in the world. So then when it comes to, okay, well, how much more room is there to run? That goes off the part of, okay, did we miss the move? Is geopolitical uncertainty going to continue? Is economic uncertainty going to continue? When can we get into this? We don't predict the price or forecast the price by any means, but we do spend a lot of time looking at the bull and the bear cases around gold. And not because I'm the gold guy, it is very hard to find really strong fundamental bear cases around the asset, along with, like I was saying, what KRISTEN was alluding to earlier, but you got to remember gold is a global asset. And as us in the room, as US investors, we like to look at gold through the lens of what's going on here. That's not fair. Like for instance, the last 2 years, rates up, dollar up, you would have said gold should have been underperforming, but that was clearly not what happened, right? And so when you look at it, gold has this unique dual nature to it, where 40% of demand comes from, jewelry and technology. Another 40% comes from investment, and another 20%, which that's grown to what it is today to 20%, comes from central banks. And so when you have high prices, sure, jewelry will start to fall off and people will start to sell to capture that upside. But then investment sticks in because you have heightened periods of volatility and risk. So now we need to start hedging our portfolios. The problem we find is that a lot of people don't look at gold, at least the US investors, to always have in their portfolio all the time. And so then now all of a sudden, when you do have these heightened periods of volatility, they're like, oh, what do we do now? Or we didn't allocate, should we? So that's really, what the two things that we've been getting the most of.
Jenny, before I get to you, I just want to dig deeper, Kristen, for a moment on something that you said regarding systemic risk. Are there specific markets or sectors or institutions that you really believe are too interconnected to fail in today's environment?
So I think, so when I think about interconnected risk, what I think has happened post-financial crisis is a lot of the activity that used to be done in regulated banks simply, I remember the merchant bank balance sheet at Goldman when I was there during the financial crisis, very large amounts of private equity, distressed debt, et cetera, et cetera. All of those activities shifted over to asset owners, asset managers first, and now to asset owners, including some of the large alternative asset managers, as well as pension plans, insurance companies, sovereign wealth funds. And so to me, to some extent, some of these markets have bifurcated a bit. The one where I think there is interconnected risk is in the credit space. So initially, you just saw a lot of lending move out of banks and into non-bank financial firms. Now what you're seeing, given the private credit market is close to $2 trillion in the US and growing, and it's actually kind of exceeding the size of the leveraged loan markets that banks still operate in. Given the size of that market and overall growth in private asset investing. So remember that we used to, 20 years ago, US pension plans mainly were investing 60-40 in equities and bonds. And then given the zero rate interest rate environment, coupled with growth in alternative markets, they started investing beyond and into private assets. And so that has grown to about a third of assets at the large US plans, and even more, it's like 60% for endowments. That growth in alternative markets happened on the backdrop of developments in the ETF and index market. So, you used to get 150 basis points fees in actively managed mutual funds. Now, because of index products where ETFs are maybe 5 or 6 basis points, fees in mutual funds are on average 30 basis points. And so you have investors that are going into the alt space because, trying to get higher yield, diversification, all kinds of very good reasons. At the same time, you have the entire fee structure kind of collapsing in traditional bond and equity markets and in fund space. And so everyone is now banks, asset managers, alternative asset managers, investors, retail platforms, very, very focused on investing in private assets, where the management fees are probably 175 basis points on average in PE plus, performance fees and carry, and a little bit lower in private credit and infrastructure. But because of that mass focus on this market, I think there's a lot more interconnectedness, particularly in credit and private equity. So now you're seeing, your banks will lend, but the loans go off the balance sheet, or they're doing loan commitments, credit lines, securitization. The assets move to an asset manager or an asset owner, but all three types of entities are actively participating in private credit markets. I think right now banks have about $1+ trillion in lending to non-bank financial institutions. I think the private credit exposure is maybe $350 billion in the US. And so it's not systemic yet, but the banks are actively lending in the PE space, to private credit space. And there's not leverage in private credit funds themselves generally, but there's a lot of leverage in the underlying borrowers. So I don't think it's a problem today, but these markets are, thinly, if at all, regulated. They've not been tested by any kind of credit downturn. And defaults are low, things look rosy, but there's no oversight or transparency. And so to me, we're starting to get that interconnected risk.
I'm going to come back to you in a moment to get your thoughts on federal regulation on private capital, private credit, but want to turn to you, Janie. You're at Zurich, global insurance company. Given the global nature of capital flows, what regions or economies are you watching closely for any potential sources of a systemic contagion?
Yeah, I will make the caveat here. Yes, I work for a global insurance company. I'm part of the investment team that's either a separate business from the insurance business itself. Sorry for that. But we are U.S. investors, so I oversight the investments in the U.S. And I think I'm lucky in a sense to being in an insurance sector that I don't know how many people knows about how insurance investment works, but it's actually a very highly regulated kind of investment environment. So the capacity that we have to move flows in and out of the investment portfolio is very limited. So for that, we have to have a strong risk metrics and understanding of what type of risk do we want to commit with, and also ensure that we have enough liquidity. So saying that, I would say the most focus right now for us is, of course, the US and the political environment here, not only looking at the international trade impacts, but also looking internally at the deficit impact. I think Elizabeth has talked about that before, and how would that potentially have implication into the pricing of the investments that we do. We don't expect a recession in the US. It's not our basic case scenario. So we don't think these measures of this uncertainty will become systemic risk, at least today. But we see potential for increasing risk if the policy continues to be uncertainty. And as you mentioned before, private market is one of the asset class that we look very closely because we are investors there. We are high quality investors. We have limitations. We want to ensure we have liquidities and we collect cash flows from the investments. But it's one that we have a close eyes on. Looking internationally, we also look at China situation. I think the real estate crisis in China has been for many years and hasn't been resolved yet. And what are the implications for global trades coming out of that situation, and the implications on material pricing, commodity pricing, and also how will the tariff negotiation between the US and China would end up. I think is quite relevant in terms of forcing China to finally focus on shifting their economic growth to more internal consumption and diversifying from external source. But that at the same time have implication in global trades, and that we need to understand how would that impact also the US. Finally, I would point to small corporations in the US and consumers that has been living in a very low cost production environment and almost free trade. This situation is about to change, or it's changing right now. So we don't know the implications that has. So we are monitoring sentiment, investment plans, and hiring capacity as well as indicators of potential risk there.
So Jenny mentions China. KRISTEN, Taylor, do you have any other thoughts, any other geographies or economies that are on your watch list?
Yeah, I mean, so I think China is super interesting. And again, going back to gold's global nature, if you're a Chinese investor, and as Janie was highlighting, you can't touch the real estate market there. You don't want to touch the renminbi. You have limitations on what you can do equity-wise. And you are technically one tweet away from trade relations going down the drain. So, because of that, we're starting to see a large increase in flows, at least into like Chinese gold-backed ETFs. So if you look at flows year to date, flows into China have already, through the first 6 months of this year, surpassed all of 2024. We're also starting to see a little bit of an uptick in flows into Japan-backed ETFs. It's a much smaller market, but at the same time, it does send signaling. At the beginning of the year, we did see a lot of flows moving into Europe. That's kind of subsided, but interesting enough, this is right now, at least in the US, again, another really strong month. At least, we have a couple days left in the month, but flows here have also been really strong. So I think that is an indication, again, where we're seeing flows globally, all net positive. And that's a reflection, again, on all the things that, my fellow panelists have already highlighted.
Yeah, I guess I would just, probably not as significant as has been happening in Chinese property markets, but certainly commercial real estate in the US, like 70% of the lending is done by the same regional banks that kind of blew up in 2023. And they actually have pretty significant percent of capital allocated to those loans. And, I think the real estate market, in recent years has been very kind of property type specific. So logistics and data have done really well. Office property and retail, not so well. I think that the two area, office property, I think, vacancy rates are 20-25% in New York, San Francisco, and other large cities. And, delinquency rates are definitely rising. And and I think depending on the direction of travel with the extent to which people work full-time in the office and reuse that office property, I think that's a bit of tipping point or potential weakness. And then remember that the interest rate environment is affecting valuations of real estate. So I think that one is, I guess, more containable, but I do think it's high risk.
KRISTEN, let me go back to the point of discussion on federal regulation of private credit, private capital. So as someone who's worked at the Federal Reserve and served on the CFTC's Market Risk Advisory Committee, how do we strike the right balance between regulatory oversight and market freedom without stifling innovation or risk-taking that's essential for growth?
So I think it's very hard to do that effectively. I mean, what I will say is when I was a bank examiner at the Federal Reserve in the early 90s, and I think regulators at that time understood and knew how to oversee lending and security portfolios. So they understood the products. They reviewed underwriting standards, and I think the regulation, obviously there was a massive kind of blow up in the banking sector and S&Ls, but that was because of improper application of the regulations. But I think I definitely get disturbed by the fact that lending, which was occurring in regulated banks by regulators that largely knew what they were doing, has moved off of has just moved almost entirely off of bank balance sheets and into unregulated institutions. And what I think is it's really hard to, like I was talking about interconnected risk and systemic risk in private credit, but there's very little data that's being disclosed, by private credit funds in the US. So not only are they not being regulated, but the regulators don't even have access to information. So to me, I would like to see more of a balance between private and public lending markets. I think private credit markets serve a purpose that you can have more bespoke lending agreements. You've got closer coordination with borrowers. You have theoretically better covenants, and those are all very good attributes. But I think there needs to be more of a balance, and I think lending should be done by the traditional banking sector as well. And so I certainly don't think the banks need more regulation. I think that Basel III in and of itself is already punitive enough, and the Basel end games are overly punitive. So it will align the US more, with global counterparts in Europe, but I don't think it's beneficial for markets personally.
Jenny, going back to the insurance sector, as an insurance investor, have you seen,
Sorry, there was one question.
We're asking about private credit.
Hold on a second.
I thought if I heard it correctly, I think you were asking more for the private credit market regulation from the Fed, correct? Not the banking sector, the private credit sector.
so
You were asking that more, right?
I was, and that turned into banking, but that's fine as well.
Okay, so yes, I do think that there should be regulation of credit markets in general, and I do think private credit should be regulated to some extent, but not to the extent that it stifles innovation the way that happened with banks. So I think there's too much regulation for banks. There's not enough regulation for private credit. I think, but I don't have a good answer to how to introduce the right level of regulation, because it seems like the regulators respond, when a market crisis evolves, they come in, they try to fix it, they put in a lot of regulation, and all that activity just moves to a different part of the market. And then something else blows up and they move over there and they regulate. So to me, I think a comprehensive overhaul of regulation, more at an oversight level, not kind of in the weeds. But I think that's highly unlikely to happen in this environment.
I would think there'll be a landscape where regulators are more proactive versus reactive.
I mean, honestly, I don't. No, not unless.
So there'll need to be a change in the administration first and foremost.
Well, yes, but also in general, like regulators don't have the same, regardless of how knowledgeable they are, they don't have the same in-depth knowledge as someone who's they're never going to know enough about investments as Janie knows actually making investments. And they're never going to know as much about risk management as risk managers do. And they're never going to know as much about gold as our friend Taylor here. But I've just seen a lot of misapplication of regulation, like even when the regional banks, when Signature, SVB, and the other banks kind of blew up, there was this call for more regulation, applying liquidity rules to banks that are of larger size. And that's nice, but to be honest with you, when I was 24 years old, we used to pull in data from all the call reports of all the banks and run basic financial ratios in Excel, or maybe Lotus 1, 2, 3. Maybe it's probably Excel at that point, but just that's the era I come from. But basically, we would have seen in about 35 seconds. Well, it would have taken 3 minutes to hit go on the Excel spreadsheet, and you would have seen that those banks basically had overwhelming reliance on non-insured deposits that were susceptible to run risk. You would have seen the mismatch in assets and liabilities. You would have seen the lack of hedging. You would have seen the investments in treasuries, and a 24-year-old bank examiner would have gone on site at the bank and asked questions. And that was, in the early 90s. So I don't think we need more regulation. I think we need standard principles and a focus on standard principles. But it's definitely broken. I mean, and I don't have an answer, unfortunately.
Any other questions?
Any other questions? Hands up and I'll run. Nope.
Just have a few more minutes. So let me turn that to Jenny. As an insurance investor, have you seen material changes or considerations in the U.S. regulatory landscape?
No, I'm scared to talk about that. Yeah, well,
You say regulation is good in insurance, right? It's better than-
we do have, yes, we have strong regulators, and I think it's good for the insurance sector to be like that. So I would say probably talk about one that has impacted mostly insurance company, which is the NAIC principal bond definition, which is looking at the increased number of structured securities in the market and in the balance sheet of insurance company. So this regulation aims to add clarity on actually the underlying characteristic of these structured bonds. Looking at the whole bond portfolios, we have spent many hours reviewing those and discussing with our portfolio managers about how to look at those. And what this triggers is a high level of transparency on actually the structures behind those ABS securities, where the regulator wants to ensure there is a true, really lender company situation and not an ownership of the underlying assets. If you have to classify those instruments as bond-like type of instruments, and these will trigger reclassifications of those assets that will not demonstrate sufficient meaningful cash flows or over collateralization. That would trigger a reclassification into different scales, so meaning higher capital requirements for those asset class. So this is the whole discussions about, we want to know more, what is the underlying risk that this instrument has, more than the legal structure of them, but really, so when we look at the potential investments, so we have these examples of feeders notes and the discussions around really what are we buying and what are those underlying assets. And not everything will have the same capital charge. You're not prevented investors to get into those positions, but at least we are aligning the risk and the capital consumption on that point of view. And the other one that maybe I would like to highlight is the discussion in the US around easing a supplementary leverage ratio for financial banking. And I think this is the ratio that was put in place as Basel III after the financial crisis for banks to keep or to avoid an excess level of leverage. And the issue is a non-risk way. So it means it treats all the assets in the same way, including US Treasury and bank reserves. And the discussions, people that favor this softening in the ratio are advocating for the change will actually add liquidity to the Treasury and lower the cost for the government on Treasury bonds. And people that are opposed to that are actually saying that this is potential source of systemic risk and kind of undermining the objective that for the reason that it was put in place after the financial crisis. So you have the two sides of the coin, but I feel like it's a really good discussion that it happens right now.
So, go ahead, yes. We have a question here.
Kind of shifting the topic. So I don't know if you want me to ask it now. Okay. Just, when I think about systemic risk, I'm wondering about decentralized finance and the growth in flows of capital towards all types of decentralized crypto assets, and what are the signposts that we should be looking for to be concerned about whether this represents systemic risk, because the characteristics around transparency, traceability are somewhat different. And also, is it regulation that causes the risk, or is it lack of regulation that causes the risk in that space?
Yeah.
We were just talking about this
Yeah.
before and hoping no one would ask us.
Oh.
So we talked about it.
So, we get a lot of questions around Bitcoin versus gold and things like that. So, but as it relates to regulation around or decentralization around crypto and assets like that, I think that's become pretty ironic, because that was the whole original premise of having these assets that are off, that aren't backed by fiat currencies and this and that. But the only way it's been adopted is to have it backed by fiat currencies and or have further regulation and actually become more centralized than decentralized. Like if you look at the blockchain, where the transaction's happening, who it's going to and whatnot. So it's interesting. I mean, even look at like right now this week with Circle, like it's theoretically just a stable coin backed by US Treasuries. It's it's just, it's an interesting landscape, but I think the only way it continues to get adopted, at least here, is more centralization and more legislation around it. You know, we can go into a very, very deep conversation about just, you know, the scope of cryptocurrency. I think blockchain in and of itself is very interesting technology, but that's got to be viewed separately from Bitcoin and all the other cryptocurrencies. And what they all do is very different. So yeah, I think it's a good question that should be asked more. Because again, I think we see these massive price returns and people go, oh my gosh, and FOMO into it. But the regulatory part and how that's going to look, which I wish I had that answer, I don't know, but I think that is something that we should be thinking about, you know, how that's going to emerge and evolve.
So do you mean that more centralization is required for institutional adoption?
So I think, so,
Yeah.
Yeah.
so, yeah, to me, the problem is, and I've looked for use cases beyond, you know, speculative investing for crypto for a long time. And right now, it's hard because as Taylor was saying, the goal was decentralization, scalability. And what's happened is it's actually quite centralized. So it's pretty hard, like there aren't effective on-ramps and off-ramps to blockchain. And when you do get off-chain, you end up, you know, you end up with very centralized entities. So remember FTX when they blew up. So you have like, you've got exposure to big central companies that aren't regulated at all. So I don't know what the answer is, and I'm certainly not an expert, but I think the technology is interesting. I've thought that for a long time, but I'm not sure how you get beyond investing in crypto as, you know, a risk on or speculative tool to something that actually provides broader value in the finance world.
Yeah.
Sean, I'm mindful that we're standing between everybody and lunch, so we might have to try and wrap this
No,
up,
that's
please.
fine. I was actually going to say, the last thing I want to do is have a panel go long into lunch. So, yes, sir.
Just to feed off of Emily's question, right? I view the origin of crypto. It's also designed to not have right. So there's any sort of so use it as an example. From four, right? Yeah, I think crypto is common.
Yeah, and I mean, I think crypto is a prominent example, but you know, not because I'm the gold guy, but technically something that is untraceable is gold. And so there is becoming you know, we're starting to see reform around the digitalization and dematerialization of gold and a lot of other commodities as well that will make that more accessible. I mean, you already are seeing, you know, to a degree, you can buy fractional shares of gold bars via ETFs. So, you know, I would say that, yeah, I agree with that. It is borderless in that regard, but so are a lot of other assets and physical commodities. And again, there are even crypto organizations that are trying to find a way to, you know, have a fully gold-backed cryptocurrency, right? So then in that regard, right, you're rather than, you know, I think the other thing too, like with ETFs or with buying crypto via ETFs, you're locked in US trading hours. It's an asset that trades 24 hours a day, 7 days a week. So if you can do that with gold, right, that opens, you know, an abundant amount of opportunity. And it doesn't have to just be gold either. There's a lot of other assets that you could do this with. So yeah, I think the globalization and more digitalization for all assets, I think in that regard is really interesting. And I think that will be a key theme to look at going forward.
Perfect. So with that, I want to thank Janie, KRISTEN, and Taylor for your time. Appreciate all of you and this great conversation. Thanks again. Take care.